Guys, we're going to be getting started pretty soon. I know I opened up the Zoom a little bit early, but we will be getting started pretty soon. Just waiting to let a couple of more folks in, okay? That isn't playing. All right. We are ready to start. I have like a gazillion and one screens open here. Welcome, everyone. It is asset management time. Thank you, thank you. I saw the whoop whoop. Oh, what you drinking, Lance?
Oktoberfest.
Are you really in Germany? You are not in Germany.
No, but it's Oktoberfest.
Oh, but in okay, in recognition of of the festival. Oh, I saw it's an actual drink. Okay, great. Clearly, I don't drink, so I thought you were in Germany. How about you, Georgina? What are you drinking? That I recognize.
It's the other kind of beer.
There you go. There you go. All right. I see a few new faces. I think I know at least of one. So we'll just go through the usual spiel. Give me 1 second. And I just lost Bibi. Oh, there you are. All right. Well, for those who might be new to this, if this is your first time, I'm not going to say make you, put a one in the chat or anything, but you know what you can do, which is even better than putting a one in the chat or saying me, etc., is guys, network. We're here not to just listen, but we're here to also find, partners, future partners, prospective partners. So feel free to put your name and contact information, etc., in the chat. It was on Zooms like this that I met Bibi. I have not physically touched this lady in real life, but we have done so many deals together. So put your stuff in the chat and, network. All right. All right. So for anyone that might be new, this is your very first time, welcome. This is the Multifamily Freedom Chasers platform. We are designed and built to showcase the fact that it is possible for working professionals to attain financial freedom through multifamily apartment investing. We have several different types of programming that we offer throughout the week. Each one either occurs on I'm going to make you co-host if I didn't already, so that you can let people into the room. All right. So our programming is basically on Mondays and Wednesdays, but they alternate, right? So right now we have these asset management Zoom. And then if we're not having it on a Monday, the other Monday would be an activation Zoom where we bring in celebrity guests, seasoned operators who are many, many steps ahead of us to show us it is possible. Tell us about their journey. You're able to ask questions. And then on Wednesdays, we either have broker calls / underwriting with Kevin and Ed, or we have our debt brokers, the Miles family, Jerry and Shelley Miles, come and tell us everything that's going on in the debt market, which is very helpful for everyone to know. So today we'll be going over, I'll leave Bibi to tell you what we're going to be going over. But if you've not met either of us, I'm Ify, I'm in Massachusetts, I'm a mom, I'm a pharmacist, I'm also an owner-operator, as is Bibi. She's in Dallas, she's also a mom, and she's a full-time powerhouse owner-operator of several hundreds of apartments, buildings. And I think that's pretty much it. I have one more thing. I think it's, you can connect with us through Facebook. This is obviously free, streamed, archived on YouTube. We have a WhatsApp a group where you can connect with us, share your wins, ask questions. I think I historically promised to put it in the chat, and then I don't put it in the chat, so I'm not even going to say it, and maybe this time I'll remember to put it in the chat. But I'll try and drop that in there for you guys if you want to connect further. I don't think I missed anything. I think that was it. You ready? All right. Okay. Take it away, Bibi.
Hello, everyone. Good to have us again. Before I start up, I'm going to just give us an intro. My purpose for this training is to ensure that we understand it. So while I was creating the slides, I decided to break the session into two. So we will not be doing everything today. We'll be doing more of practical next week, because you understanding the theoretical part might not just do you any good. It's important that you know how to apply it. So I'm going to do a case study next week and show you the implication of what each capital stack can do to you and all that. So please hold on. Sorry, I just had to tell them to reduce the volume. So, yeah, so the purpose is for us to understand it to the best of the way I can help you understand it. So today we'll be discussing capital stack and GP split. Some of us are not aware of how you can really structure a deal and make it pencil out. So there are ways you can structure a deal, and because of the capital stack, the deal will pencil out and give you good returns. So if you don't understand how to use it or when not to use it, because the excess of it is also a problem, you don't also want to do that. So you need to understand it both ways so that you know when to apply it and when not to apply it and all that. So I'm going to start, first of all, to define what is capital stack. Capital stack is, in a multifamily real estate, is acquiring a property with the necessary fundings. So if we understand that we're acquiring a property because of the necessary fundings, it's important that we know how to arrange them. I'm going to show us a diagram of what I'm talking about, what a capital stack is. Please just bear with me. Let me continue. So can you see my screen? So this is a diagram. I'm using a pyramid and also another diagram, but I want you to focus more on the pyramid.
Bibi, are you muted?
Can you hear me? They can hear me?
Yes, we can hear you.
Okay. So I'm using a pyramid, and the reason why I'm going
Bibi,
to,
I think you're muted. Can you hear me?
Ify, I think it's your audio that is bad. I think everybody can hear me.
I can hear you.
Can you hear me? And Bibi, not Ify. Can everybody hear me?
Yes, I can hear you.
Okay, good. Thank you. So let me continue. So I'm using the pyramid to describe it because of what it means. For example, if we have a loan of $10 million, a purchase price of a property, let's say you want to buy a property in Texas, and the property is worth $10 million. The bank normally gives the biggest chunk of the debt on it. But some people just do the bank and bring the down payment. There are other ways you can reduce the money you're bringing for down payment and ensuring that this deal is profitable to you. And we have the mezzanine, and we have the preferred equity, and we have the common. Common equity is the one you bring down, or your GPs, or your team members, your LPs. That is what is called the common equity. So I'm going to explain this further down the line. But what I'm emphasizing more on this,
Are you sharing your screen?
what I'm emphasizing more on this, why I'm showing you this diagram is for you to see the level of the risk and also the amount of debt that each position attains. So if you look at the senior debt is bigger, the mezzanine debt is second biggest, and the preferred equity is the, and the common equity is actually the smallest.
Are
And
you
if you
sharing
look
your
by
screen, Bibi? Share your screen.
So screen sharing mode is on. I think what Daryl is asking is, can you make it go into presenter mode?
No, I can't because I want to remove it and talk as well.
Oh, okay, they couldn't see.
Okay, let me do it a little. Let me do it and take it off. So can you see it now?
Mhm.
Is it better? Okay,
Well,
so
all of us can see the screen. Right. We can see it.
okay. So please, can you guys just allow me go through this without any interruption, because I lose my train of thought and I don't want to. Okay, so let me go back to this. So the idea of this capital stack is two things. It's showing you the amount of debt or funding you're getting on each level, and also the risk on each of them. So if you look at this arrow downwards, you see the lower the pyramid where the debt is, the lower the risk. And the higher it goes, the higher the risk. And I'm going to show you why that is shortly. Another thing I also want you to look at is the capital stack on the other side of what I'm sharing. The senior debt and the mezzanine debt is described as the debt aspect of the capital stack, whereas the preferred equity and common equity is the equity side of the stack. So these two are debt under the debt category, whereas these two are under equity category. So for example, you want to buy a property of $10 million, and the lender is saying they want to give you 7 million, and normally you're supposed to raise 3 million. You can decide that, okay, I don't have 3 million, I don't have investors that can give me 3 million. Okay, I'm going to structure it this way. 7 million will go to the lender. Lender is giving me 7 million, which is 70% LTV. So when you hear LTV, that's what they're talking about. So if the lender is going to give you that, you can say, okay, I still want to get the mezzanine debt also, and you can actually get that from a senior debt lender, or you can get it from another bank, someone else. But the senior lender must give their consent, must give you a go before this mezzanine debt must work. But typically, I like to take the mezzanine debt with the senior lender if they are open to it. But if they are not, maybe we have a lot of equity on that property. We can bring in another lender to give us the mezzanine debt. So this is $7 million, 1 million debt. I can decide that, okay, I still cannot raise 2 million. I can only raise 1 million. I can bring in a pref equity person to give me 1 million, and I'll raise the remaining 1 million. Maybe myself, my GP members, and some LP limited partners will come up with this remainder of 1 million. You can decide to do that. In that way, on this deal of 10 million, you only raised 1 million, and that is fantastic. So by the end, I'm going to give you the pros and cons, why this might not be. You might need to consider not doing this a lot. So the overview of a capital stack. So let me share my screen again and give you the. Sorry, I'm trying to get out of this mode. Okay, go to slide. Sorry, guys, I'm not used to. Okay. Okay, so now I'm going to share my screen again and show you this. So the capital stack overview, like what I've explained, we have the senior debt, we have the mezzanine, and we have the equity portion, which is the preferred equity and the common equity. For the senior part of it, it is the repayment is the priority. So when you take a debt from the first debt from a bank or from a lender, maybe Fannie Mae or Freddie, because those are the people that normally will give you the first debt. We have the federal government. I mean, the federal government can give you that through Fannie or Freddie. You can also get it from the bank. You can get it from a community bank. You can get it from a CMBS bank as well. So there are different ways for you to get a senior debt. But when you get it, typically it's between 65 to 80% of the purchase price, and is the highest priority. And they have, in terms of risk, their risk is very low, because if anything happens, your property becomes the becomes the collateral for them. So let's say you're not able to pay them, they take it as the collateral for what you owe them. So that is why it is regarded as a low risk kind of capital stock. The next is the mezzanine. Is the secondary after the senior debt. And that one has a slightly higher interest rate than the senior rate. So if the senior rate is let's say 5.5%, a mezzanine debt might be 7.5 or 8%. It can even be up to 9%. It just depends or where you're getting it from. Some people might give it between 8 to 12%. So that's the kind of the disadvantage about a mezzanine debt. But the thing about it is that it's usually a small portion of a debt. So if you're looking at the interest rate, it might not really be that much in terms of payment. It's typically higher than the risk involved in it is typically higher than the senior debt. And after the senior debt is paid, they are the next in terms of priority. So I'm going to shift gear to the equity part of it. This is preferred equity. So many of us have been hearing about preferred equity. How does it work? We have preferred equity partners that can give you such money. We have, what do you call them? Family office. We have big corporations that can cut out big checks and give to you. Even third-party lenders can also do that. There are many out there, so you can actually look for them. The risk about this is that if anything happens, if your property gets foreclosed or maybe you're not able to pay them, they can take the ownership of the operations of the property. So they put a lien actually on the ownership of the property. So if you say you're not paying them, they can decide to not take ownership, they now become the operator, they now become the owners in terms of the operators, and they displace you. So preferred equity kind of have power to do that because there's a lien that they put on your ownership for the property, and they do that through a legal document that they present to you to sign. So it's important that you check the legal documents before you go ahead and sign. So one good thing about preferred equity is that they're entitled to a fixed return. So regardless whether you make profit or not during your cash flow period, maybe during your whole time, you will need to pay them. It can also be deferred. So probably during your first year or your second year of operation, you found out that you didn't make profits and you don't have any cash flow to pay them, you can choose to defer this down the line. But the idea about it is that before any form of payment, after you've paid your senior debt and mezzanine debt is made, they come first. So after those two, they're priority. And the third one is the common equity. This common equity are people like us, the GP and all that. So if there's no profit, if there's not, maybe there was no cash flow, maybe you've paid out all your cash flow to your senior, your mezzanine, and your equity. If there is nothing, you go home, there is nothing. You don't have any money. So that is the disadvantage of the common equity. But the good thing about the common equity is that they kind of receive a very good return in the sense that they receive cash flow if there is. They receive the tax benefits if you're doing what do you call it, tax depreciation and bonus depreciation. They're the ones that take advantage of it. These other levels of the capital stack, they don't take advantage of those things and all that. If you sell, you also have the ability to get profits as well. So the common equity is actually divided into the limited and the GP. So under the common equity, that's where you find the general partners and you also find the limited partners. Is there a case whereby the limited partners can also be entitled to preferred returns? That is, to make their returns guaranteed after other debts have been made? Yes. There's a way that you can structure it that protects your limited partners, and I'm going to discuss that shortly. So in summary, this is what I'm talking about. I have a property, the purchase price is 14 million. I can finance this property this way. Let's say the senior debt lender decided to give me 65%, the mezzanine 10%, the preferred equity partner 10%, the common equity I was able to raise for my GP and my LP 2.1 million. You can arrange your capital stack. In quote, this is exactly what I'm talking about. But there are more complex capital stack. I'm going to dive into the complex one next week, not this week. But for this week, sorry, I have for this week. Now I'm going to talk about how can a limited partner be offered a preferred equity and at how much. I've seen limited partners. I've seen limited partners being offered between 6 to 18% in recent time. I've seen that happen. That is, the GP partner, in order to attract more limited partners, can decide to give the limited partner preferred equity. And what is it trying to achieve? Or what is the general partner trying to achieve? They're trying to attract the limited partner, number one. And number two, for the limited partner is a guaranteed amount that they will get, regardless of if there was cash flow or not. It can be deferred. That is the thing. So if you did not make money, you can defer it to when you are exiting and pay them off. The bottom line is, after the senior and the mezzanine have been paid, they come first and all that. So that is one thing limited partners would like to see, that, okay, I did not make cash flow. Yes, you don't make cash flow, because if I did not make cash flow, it's not guaranteed. And that's what you guys should know. The 70-30 split is not a guaranteed amount. Is as a result of how profitable a property is. So if a property is not profitable, I didn't make money in my 1 year. Let's say I structured a deal and I didn't put preferred returns for my limited partners. Assuming I did not make money, I can decide that guys, I didn't make money, there's no profit to share. But in the case whereby I promised or gave them my word, 7%, you will get it. Whenever it is that I have that money, either during the whole period, because it's paid annually, I can decide to structure it on a quarterly basis. Instead of giving them a chunk amount of money annually, I can decide to give them quarterly to cover up for 1 year. But if I say that I don't have it because I didn't make so much, I can defer it to maybe year 2 or year 3, or when I'm exiting. And that's where we can, when we talk about waterfall, I will explain that also next week, what waterfall is, how you can spill it over, but does not take you away from your responsibility. So preferred returns is a guaranteed way of securing your limited partner's money. In my deals, I try to structure it without it, and sometimes with it. It just depends on my deal. So, for example, if my deal is so profitable in terms of cash flow, that means regardless if I do the barest minimum on the property, I will still make good cash flow. I don't get to put preferred equity, because preferred equity for the GP is a negative. And let me explain why. Because our source of returns, or what makes us happy, is from 3 basic things. From the acquisition fee. So when we sell, I explained this to you guys last week. So when we sell, there's something called acquisition fee that is paid to us at closing. When we buy the property, acquisition fee is shared to the GP. So that's one way a GP gets money. The second way a GP gets money is through the cash flow. That means the 70-30% split. So if I don't make profit on that property, that means I don't get to get my 30%. So it's not really a motivation for a GP partner. But this is, for me personally, on my deals, this is how I've structured it, so that the GP partners will not be disgruntled, or will not feel that this deal is not making money and it's only the limited partners that are profiting from it. This is what we do. I encourage the GP partners to put in their money, invest it as a limited partner, so that when a limited partner is getting returns as a pref returns, you also are benefiting from it. In that way, you're not feeling the crunch of LP-GP split of 70-30. If that comes, because there's so many factors that determines how profitable a property is. You might be operating it well, but things like maybe insurance might come up. They might increase the insurance, they might increase the taxes. Things might go off that you did not envisage for, that is actually beyond your control. Or maybe you have a fixed variable rate, and you have a floating rate, and your interest rates climbed from 3% to 9%. Obviously, that will eat up your entire cash flow. So you might not have any cash flow to distribute to yourself or to your limited partner. So to make everybody happy, I always encourage GP members. Yes, we're told that you can actually invest no money in multifamily real estate. I try to encourage people, if you're a GP partner and you're doing a perfect equity deal, try as much as possible to put in something, so that when your limited partners are having money, you also benefit from that thing. And when you now make profit, you also make money as a GP member. So in both ways, you are making money. So that is what I've been doing since I started. So all our deals, we actually invest our money. Most times we even invest more than, we're the highest investor in the deal, because we know the deal, we understand the deal, and we want to take advantage of the opportunity that the deal brings to us. So please, this is a way you can mitigate the risk of just having perfect equity. I'm talking now to the GP, to a GP. For a GP, this is important, because we're told that don't structure a deal with preferred returns. But me, I'm telling you, you can structure a deal with preferred returns, but put at the back of your mind that you should invest in that deal as a limited partner, so that you have a guaranteed returns as well as the limited partners. So looking at this example, if I raise 3 million for my LPs and I promise them a 7% preferred returns for 2 years, so the 7% is 7% of the 3 million, and that is about 210,000 monthly. So for the 2 years old, I'm assuming I'm holding this property for 2 years. If I'm holding it for 2 years, this is just the returns during the whole period. This has nothing to do with the sales. If I'm selling as well, I'm still going to give them their principal at that time as well. So for the period I'm holding it, I owe them 7% each year. So over the 2 years, I'm giving them 420,000 as their preferred returns. So to the next slide. So this one is a little more complicated. So the same, sorry. So the same example, but a little more complex. So I'm having dual structure in this. In this one, I'm having some aspects. I'm giving preferred returns to my limited partners. I'm also I have a preferred equity partner also on this deal that I'm supposed to give preferred returns. So let's go back to this diagram. Remember here, I have preferred equity. This preferred equity can be a third-party lender. It can be maybe an investor. It can be someone that has a big check, big money. It can be a family office. It can be anybody. This is, and their interest, their interest rate is typically between 12 to 18%. So if I have this kind of people, I still owe them, based on how it is structured, I still owe them preferred returns. And let's say here I have my limited partners and myself or my GP members here. And I've also promised the limited partners that under the common equity preferred returns. And that means the limited partners that are here, I also owe them preferred returns as well as the third party investor that borrowed me money. So I'm owing to people preferred returns, but they all fall in different categories and all that. So going back to the complex capital stack I was talking about, going back to it. So what I'm trying to say here is, in this scenario, I have two people I'm giving preferred returns to. One is a preferred equity partner, the one that gave me, let's say 3 million. And I have also my limited partners, which are the LPs, that I just said I was going to give them 7% preferred returns to make this deal attractive. So the key feature of this is that both groups are compensated before common equity holders. So in this category, you have two people that are collecting the preferred returns. I'm going to compensate them before the GP on the common equity side. And this returns is also fixed, just like I explained. So for example, my limited partners gave me 3 million and my preferred equity partner gave me 2 million. And my limited partners, I'm holding it over 2 years. Over 2 years, I owe them 420. And my preferred equity partners, let's say they're giving me this A type, it's supposed to be 2 years, but let's just go with the example. So my preferred equity partner, I promised to give them over 3 years, 900,000. That is a percentage of the 2 million that they gave us throughout the 3-year-old. So my total preferred returns will be 420 for the limited partners and 900,000 for the preferred equity partners. And the combined of preferred returns is about 1.332 million. So remember when I started, I said that you need to be careful how you structure your deals so that you don't eat up all the cash flow from your deal and all that. So that is for the preferred equity side. So now I'm moving to the common equity. That's the last category, which has the highest risk. So the common equity is the GP-LP split in this category. So the GPs typically take between 20 to 30% of the profit. That is, the profit here now is the cash flow. Whereas the LPs here take between 70 to 80%, depending on what you're offering them. So it means that the LP members go on with 80% of the profit, and the GP members goes on with 20 to 30% of the profit. And this is after you've paid them their preferred returns. So after you've paid the LP members their returns, their preferred returns, that is when you can go ahead and do a GP split. So if there is no money, there is no GP split. So if you look at my screen, this is a sample of a GP split. So let me explain it briefly. We're going to do the practical of this next week using an example. So after I've paid my senior debt, I've paid my mezzanine, I've paid my preferred equity partners, and I've also given my limited partners their preferred equity. Let's assume I'm left with $500,000 at the end of the year. This is the GP split. I'm going to use this GP split to divide it among the my GP members. So this split is actually for the GP, not for the LP. So the LP will take 70% of the 500 and the 500,000 that is left. The remaining amount from the 500, which is the 30%, now comes to the LP. So you can structure your GP split in this way. So for a GP split, there are different categories. So it depends on you, how you want to structure it. Some people have only 3 items under their GP split. Some people have 5, some people have 6. But for me, this is the standard GP categories that I've decided to use, and I will explain them shortly. So in this category, you have sourcing, contract, and closing. So in this category, whoever, let me make it bigger so that we can see it. So in this category, whoever is sourcing the deal, that means the person that called the broker, got the deal and put it under contract, will fall under this category. Whoever is discussing this thing with the lender, you're going through the closing process and all that, all of you are under this category. This category entails due diligence, contract closing, sourcing for your property manager, bringing in the team. This category falls under that. So we have the risk capital. This risk capital are people that, please, if you have questions, maybe you can ask me, but I'll just take one if there's anyone now before I continue. So if you have one, just let me know. So the next category after sourcing, contract, and closing is the risk capital. And why do we put this as a category? Because it's actually risk capital. The money, there's some funds, some money that you have to put down before you close. And let's say, for example, you did not close the deal, or you're not able to raise the equity, or you pulled out during the due diligence, you found out that some things were not right, and you decided to pull out of the deal. The money you spent ahead of time can never be retrieved, it's gone. So that's why it's called risk equity. So monies like EMD, monies like the money you pay to your lawyer to do the documents, maybe your transactional documents, that is your operating documents, the money that you use to pay your SEC. There's the money that you pay to the lender to conduct appraiser and environmental, and they call it goodwill money. That money goes ahead of time and is not refundable as well. So all those monies are called risk capital, and you are not getting them back if anything goes wrong. So that is why some people give it a big amount of percentage. Then you have the balance sheet guarantor, people that will help. They're called the key principal, the ones that will use their net worth to sign as a guarantor on the deal. If you've watched my video, I explained what the net worth of a deal should look like. So if you're bringing a KP to help you become a guarantor on your deal, the KP must have a net worth that is equal to the loan amount. So if the loan amount is 7 million, the KP must have 7 million and above net worth, and also must show 5 to 10% cash liquid in his account. And if it's for for a government, which is the Freddie or the Fannie, you must show some form of experience. But if it's the bank that is the lender, you don't need to show any experience. But they will want to drill down into who is managing the property. That is, the property manager now becomes very, very important if you're dealing with a bank. So that is for that. Then the next aspect is the asset manager. This is the only role that continues after every other role has ended once you close on your deal. So these are deals, the sourcing, contract, and closing are before you close on a deal and when you close on a deal. The day you close on a deal, this role ends. The risk capital, the day you close on your deal, this row ends. Balance sheet guarantor, this is ongoing because the bank will keep reassessing, especially if you get the loan from the bank, they will keep reassessing. From if a bank is your lender, the bank will keep reassessing the guarantors. But if your lender is Fannie or Freddie, they will keep assessing the property and all that. So it depends on who you're getting your loan from. These people's role might not end at closing. So it just depends on whoever you're dealing with. The next one is the asset management. This is the only role that starts from the beginning and ends at the end of at the time you sell. Even after you sell, there's still some jobs you'll be doing after the sale of the property. So this role, I tend to put an emphasis on the percentage that goes in there. I try to reward it a lot more because it's a role that is ongoing, and without this role, this entire deal is going to you might not succeed. The next one is investor relations. So sometimes I categorize investors relations and capital raising as one. So on my deals, I put them all together because if you're raising capital, you are actually creating a relationship with your investors, and the way to do it is through communication. So that means you'll be sending out informations to them and all that. So you cannot leave one and do the other. They are intertwined. So I tend to add them together. It's only on very few cases when I'm trying to give people an opportunity, maybe for different reasons, like maybe they can't raise money and I see that I want to assist them in starting up a deal. I might bring them in here to just support for them to do their first deal. But really, I tend to put both together as one role. So this is like an idea of what sorry, I'm trying to exit. So this is an idea of what a GP split is. So if you look up, let me go back again. If you look up, you'll see this part, percentage of GP and deal ownership. When we are sharing, let's say the GP members made 500,000 as profit from their cash flow. This is a percentage that will be used to divide what, sorry. This is a percentage that will be used to divide what each person will go on with. So for example, if we made 500,000 as cash flow, that is 500,000 of the, the 30% here that you're seeing here, that means the GP members made 500,000. Let's assume we made 500,000 and the LP made way more than that because they have 70%. So if we made 500,000, that means Bibi's share out of this 500,000 that we made is 23.3% times 500,000. That would be the cash I'll go on with. And Jack, we go on with 17.7% of the 500. So this is how you get the money, your share of whatever you have as your cash flow or whatever it is. But this deal ownership is the amount of the equity that I own on that property. So it shows me that in this big property of, let's say, $10 million, let's say the deal is $10 million, that means Bibi owns 7% of that asset. So that means I own 7% of it, and Jack owns 5.3% of it. Joe owns 7.63% of it. You keep going like that. So this shows ownership, and this shows what this is used to share the money or returns or profit or whatever it is. This is what you use to share it. But for in terms of ownership, this is what it is. This is what you own on that property. I hope I was able to explain that very well because I don't know if I did a good job on that. So was it clear enough, or you need me to go back to it? Can anybody hear me? Okay, let me move on to the next slide. So
There's feedback in the chat. They said it's clear.
okay, it's clear, good. Okay, so this is an example I created. So I have two examples. One is complex, the other one is not. So let me explain this with this example. So I have a purchase price. I have a property in Texas. It's 14 million. And for my underwriting, I realized that I want to hold this property for 3 years. That means in the third year, I want to refinance or I want to sell in the third year. And with my underwriting, I realized that if I'm able to perform or do well on this property, work on the NOI, this property in 3 years should be worth 22 million. Fine. So how do I raise the 14 million to buy this property? The lender has done their underwriting and they said they're going to give me 65% of the 14 million. So that means they're going to give me 9.1%, 9.1 million at an interest rate of 5.5%. 9.1 million minus 14 million, that's still a lot of raise. That means I still have to raise over 5 million, maybe 6 million, including closing costs. And I've looked at my surroundings and my friends. I'm not sure I can raise it. I said, okay, I'll go look for mezzanine debt. I'm going to ask the seller, the senior debt, if they are opened with me doing a second position mortgage, that is getting another lender to give me a mezzanine debt. And they said, yes, go ahead. As long as it does not exceed this number, we are open to it. I go to meet my lender. I need a second position mezzanine. And they said, based on their underwriting, we can only give you 10%. I said, okay, fine, give it to me. I'll collect it. So that means I have 9.1 plus 1.4 million, but my mezzanine is at 8%. Gradually, I'm filling up the gap. And I did my calculation. My 9.1 is about 10.5 million. I'm still far off. I still have to raise maybe 5.5 million or 5 million. So I need more money. So I called on my preferred equity partner and I said, can you please give me more money? And they said, okay, yes, we'll give you 10%, 1.4 at 12%. I said, okay, no problem. And I know that and I accepted. Then for the common equity, at this point, I'm only left to raising 2.1 million. I decided to call my friends as GPs. We all came together. We put down our money. We also raised some from the limited partners. And this time around, there is no interest on this. This is just a perfect equity. This is just a 70-30 split. I raised this money and all that, and I'm able to raise the entire 14 million. So based on that, this is what this looks like. So let's go to the next example to see what that would look like. Sorry, not the next example. So what would the sale of that property look like? So let me go back to this slide. Looking at this, that means I owe my preferred equity partners 1.9 million as including their initial investment. They gave me 1.4 million at 12% for the next 3 years. That means I owe them 1.4 plus 504, the total of almost $2 million. And my common equity is 2.1, 70-30 split. So going to the distribution side in terms of sale, let's assume I've done the property, we've worked on it and everything came out well. I was able to sell this property for 22 million. So this is how the payoff will look like. I'll pay off my senior lenders 9.1 million. I'll pay my mezzanine lender 1.4 million. And I'll first of all pay my preferred equity partners their 1.4 million that I owe them, their principal, and I'll also pay them the returns, the preferred returns on it, which is about 504,000. I'll pay them off. Then after I've paid them off, I have a remainder of 9.5 million. It is now this 9.5 million I can now distribute with the LPs and GPs. So the LPs will now take 70% of this 9.5 million left, and we, the GPs, will take 30% of this 9.5 million left. Now, the problem with this is, what if this deal you're not able to sell it for 22 million? Let's say you sold this deal for 18 million because the economy was bad. interest rate went up. Because the interest rate went up, my net operating income was very low. I was not able to sell it for what I projected it was going to be. That means I might be able to pay off everybody, but I will not be able to make any money to give my common equity partner. So that is why this is the highest risk in the entire thing. So let's go to the next. Let's say, for example, on this deal, I was able to make everything I said I was going to. So this is the same example, but on this deal, I had a cash flow of 2 million. That means during my 3-year-old period, after paying my lender and the mezzanine debt, I was able to make 2 million. No, sorry, I made a cash flow after removing all my operating expenses. That is, from my income, let's say my income was whatever amount, my income was 4 million, my expenses were 2 million. So after I removed my expenses from my income, I made 2 million as my net income. I mean, I made 2 million from it. So going by that, this 2 million in the payback category on my capital stack, from this 2 million, I'm going to pay the lender for 3 years, 1.5 million. So this 2 million is a sum of year 1, year 2, year 3. So let's assume I made 2 million year 1, year 2, year 3. I'm going to pay my lender. I owe my lender 1.5 million, approximately 1.5 million. Then my mezzanine debt, for the 3-year-old period, I owe them an interest of 336,000. And for my preferred equity partners, I owe them 504,000 for the entire 3 years. And the common equity, I don't know what I owe them yet until we get there. So if I pay from cash flow, from the 2 million cash flow I have, I pay my senior debt 1.5, and I pay the mezzanine debt 3.36, and I pay this 504. The 2 million will not be enough to cover the preferred equity, the preferred returns for my preferred equity partners. So look at it. So the 2 million cash flow I made, I've paid the lender 1.5, the mezzanine debt, I've paid 336,000. Then the remaining balance I have from the 2 million is about 161. That means I still owe the preferred equity partners some money, and I don't have it. So I have unpaid 343,000 left. So from the sales and proceeds, so it means that anytime I decide to exit, this money is not going to go away, but it's going to be deferred. So that's what we call waterfall. I'll explain it better in our next episode. So this 343 will be deferred to whenever I have it. So preferably when I sell, that's when I know I can have a large chunk of money. So I will push it to year 3 and decide to pay them. So in year 3, I've sold the property. I sold it for 22 million. I'm paying back the bank their original principal. So I'm assuming that this entire thing is interest only. I'm not paying them their principal. I'm just paying them interest only for the entire 3 years. So at the time of sale, it means that 9.1 that the first lender gave to me, I'm paying him back from the 22 million. My mezzanine debt, I owe 1.4. I'm paying them back from the 22 million. Then after that, now I will move to the equity part of it. Remember, I still owe my preferred equity partners 343. I have to pay that first. So after paying that first, I'll pay that first and also pay them their initial capital. Let's assume they gave me, I don't know what they gave me, maybe from this slide, they gave me 1.4 million. I'll pay them the 1.4 million plus so I'll pay them the 1.4 million plus the 343,000 that I owe them. Sorry, I did not include that here. So, but understand the idea. I'm going to pay them their principal and pay them the preferred returns that I promised to give them. I'm going to pay them off that. Then the remaining proceeds after the debt payment, after I've paid everybody their money, let's assume this is not correct, because if you take off the 1.4 million, you should have about 9,496,000. So the remaining cash flow of my sales, my proceeds, let's say is remaining approximately 9.5 million. That is the money I'm going to split with my LP team and the co-GPs on my team. That's the money I'm going to split with them. So you can see that. So from this analysis I've given to you, yes, the common equity partners, actually, if the property did well and all that, they gain a lot. They gain a lot of money at closing, they gain tax returns, they gain a lot, but it's still the riskiest. It's very, very risky and all that. So what are the, I'm now moving forward to the pros and cons. What are the pros and cons of becoming over leveraged? Because you also don't want to be over leveraged. When I mean over leverage, that means you don't want to carry on so much debt. Although it has some pros, some advantages. If you have so much debt, it gives you some advantages. And at the same time, it gives you some disadvantages. So what are the pros in this category? For the pros, we have increased returns on equity. What does that mean? It means that what that means is that because you're investing little portion of your money in it is small, but you're gaining cash flow. You are gaining maybe preferred equity if your deal was structured with preferred equity for your LPs. You have your tax returns. You even have ownership of that property. You have significant ownership on that property. So if you do have it, that is one of the pros of structuring your deal in this form. Another pro of doing this is tax benefits. So for every debt or every loan or every interest you pay back, there's something that they give you at the end of the year. I don't know how many of you have taken note of it. They call it returns on interest paid. So the bank will issue you every year. They give you a total of the interest you've paid and that you've paid on the loan you took from them, and you use that returns to write off your taxes. So if you've not been collecting that from your lender, or maybe they've been sending it to you and you've not been using it, then you are losing money, because that interest paid, I've forgotten the name, but the idea is that the amount of interest you've paid, the lender will issue you a form and you can use it. Thank you. 1098 mortgage interest statement. That is it. So they issue you that. So if you are paying a lot of interest, like that is, you are paying the senior debt lender, you are paying the mezzanine, you are paying your preferred equity partners, all those things can be write-offs for you and reduce your tax liabilities. So that is one benefit of being over leveraged. Another one is capital efficiency. That is, you don't have to that means you can use your money. Let's say I have 10 million. I can decide that since I've gotten capital from other sources, my remaining 9 million, I can decide to use it to do other deals because I have a deal funded by other people's money at this point. So it will release your cash to do other investments, other projects. This is one benefit of being taking on more leverage and all that. Then inflation. In this category, how it will help you hedge inflation, especially for debts that are fixed. So if you have a fixed debt, regardless of if the property rent went up or whatever thing happened, maybe inflation went up and things have really gone bad, you'll still be paying the same interest rate because it's fixed. So that is one pros of having more leverage at that time. So what are the cons of having more leverage? I think because of the cons, I'm not going to even advise you to be over leveraged. So one of the cons of being over leveraged is higher risk default. So for example, if your property did not perform very well, maybe due to many factors, your property manager was not performing well, or the economy just did not do well, you have high vacancies, your income was low and all that, so you're not able to bring out a lot of cash flow. If that happens to you, that means you might be at default. That means you might not be able to service those liabilities you've taken on from those lenders. Because there are so many, you might be prone to default. So you need to be very careful when you're taking up so much leverage. Exposure to interest rate risk. So for example, some of these categories, they are not fixed. Some of them are floating rates. You might have a mezzanine that says, I don't want to give you fixed, it's floating. Or you might have a preferred equity partner that gives you one kind of very funny structure. And if that happens, imagine how the Fed was increasing the interest rate. People that had a floating rate of 3%, they now had 9% and all that. If that happens to you, then you're in deep trouble. You don't want to allow that happen to you. So it exposes you to risk interest rates when you have a floating rate. Then reduced flexibility. You will not be able to do so many things. Like if you have some capital projects to execute and maybe you did not raise the money at closing, you're banking on the income after paying your lenders to run those projects. You might not have that flexibility of any income to do the project because you don't have money and all that, because your debt has taken up your entire cash flow. Then potential for negative equity. So let me explain this. I'm going to really narrow down into this because this is the reality of what is happening in this market. So I'm going to take us back a little. In 2022, we found out that properties went very high because interest rate was low. People were buying properties at outrageous prices for what they were not worth. So properties that were actually worth 9 million, we saw people buying it for 20 million. Crazy, right? This is reality. It happened. People bought property way above its value. So now the Fed decided, I'm going to beat down inflation. And one of my two is I'm going to increase the interest rate. So the Fed decided to start increasing interest rate and increased it 13 times. And because they did that, interest rate went up, and interest rate has some effect on cap rate. So when interest rate is going up, the value of the property is also going up. And when the value of the property, when the cap rate is going up, when interest rate goes up, cap rate goes up as well. So when the value of a property, when the cap rate is going up, that means the value, you are losing value. That means your property that was worth 10 million might actually become 14 million because the cap rate has gone up. And that's not what you want. And that happened. That really happened to so many properties. So we found some people that bought their property for 9 million because the cap rate went up. They bought their property for 20 million because the cap rate went up. This time around, the property was now worth 13 million. So they've lost about 7 million because of the cap rate. And doing that, they will not be able to exit from that property. Rather, they have to sell, and if possible, bring it out of pocket to pay the difference to the bank. We saw this happening, and it's still happening. So this is what really happened. Some of them were over-leveraged. They had a first position, they had a preferred equity partner, different things, different structure, and they bought it for the most outrageous prices. So this is one good thing I always tell people: follow the fundamentals of real estate. If it's not penciling out, if the deal will not work, don't beat it. It's not going to work. Leave it. Move on. Go to another deal. It takes us months, years to get one deal. Like we're currently under contract on a deal, and it took us more than 10 months to get that deal. The deal we did last year took me a year to get one deal. So if it's not penciling out, don't be emotionally attracted to it, because these are the implications. You will find out that you become negative, you have a negative equity. So a property that you bought for 9 million, for 20 million now becomes what? 9 million. How are you going to pay the difference? How are you going to pay your lenders? How are you going to pay your preferred equity partners? They will come after you. So imagine if you were the guarantor to those debts, then you're in trouble. They will not only come after you, they will go after your properties. That is for the bank. So if you have a recourse loan, then it's not limited to the property that is going to be foreclosed. Your own properties will also be foreclosed. So, but if you have a non-recourse loan, then it's limited to your own property. It's limited to the property that is being foreclosed on. So you just need to be very careful and follow the fundamentals. Don't allow anything just derail you and say because you want a deal, you take on different types of equity and all that. You need to itemize it and see the risk and the effect and all that. So in summary, before I end this presentation, I'm going to just summarize by saying that the understanding of this will help you structure your deal. You can actually be very profitable if you structure your deals well. When you add preferred equity to a deal, you find out that your deal, the returns becomes better for your investors. The negative part of it, that it affects your cash flow. So your cash flow might be affected because you are paying out preferred returns to your investor. In other words, it has affected you indirectly. That means you might not have cash flow. But for me, the way I've mitigated the risk so that it doesn't affect, because that will most times affect the GPs. The way I've decided for it not to affect me, since I'm paying my investors, the limited partners, or whoever I'm taking that from, preferred returns, I've decided to invest also as a limited partner. So whatever guaranteed preferred returns they are having, I'm going to take advantage of it as a GP member. So that is the way I have chosen to mitigate the risk of not having cash flow for the entire deal. So next week, what we'll be doing is, so for next week, let me project it. So next week, this is what we'll be doing. Let me share my screen shortly. So next week, we'll be going through more complex example. That is, when we have two preferred equity, that means we're giving our LP pref. We're also giving a preferred equity partner pref. And we have a 70-30 split. I actually structured a deal. I'm going to structure a deal like this in real time. So this is, I'm going to give us this example, and we're going to see a scenario and work on it, and we'll see the implication of what this will look like at the end of the day. Then also, I'm going to define waterfall definition and how you can allocate it, or I'm going to show you how it presents itself on a deal. So I'm not paying you this year because I didn't make money. Where does it appear? When will I pay you that money? When will I have that money to pay? So I'm going to explain what waterfall is and the implication of it. Then I'm also going to do a practical example of a GP split. What I did was theory. I'm going to do a GP split. Let's say we made 500. This is how much Bibi is getting, this is how much Jack is getting, this is how much and JC is getting, and all that. So next week is more of practical on a deal, so that we can understand it and go and implement it to our several deals. Oh my God, I don't know, Ify, please, over to you. I don't know if I did justice on this, but by next week, I'm sure you guys will understand it, the nitty-gritty of this at the end of the day.
Amazing. I know there were two questions. I don't know if this is something we can ask now. I know Hoover was asking, what about principal pay down? I don't know in relation to what. And then
Principal paid as if for the debt or for the equity portion of it.
yeah, I'm not sure. I don't know if she's still on. And then there was another question.
Yeah, I said, okay, I understand it. So for principal pay down, I remember I made an example. I said, we are assuming this is an interest-only deal. That means we're not paying principal. We're not paying principal for the senior. We're not paying principal for the mezzanine. We're just paying interest. So if that is the scenario I'm giving, I'm not giving a scenario of principal pay down. No, I'm not doing that. Maybe next week we can do principal pay down plus interest. And so this is an interest-only example that I created.
Right, and then she also asked what the interest rate on pref equity is, and I think that varies.
It varies. It depends on the pref equity partner
The
you're
group,
working
yeah.
with. Yeah, I've seen 14, I've seen 18, I've seen 16, 17. It just depends on who you see or the risks for them and all that. So yeah. And sometimes it's structured again differently. So the pref equity partners might decide to structure it into categories. So they might make one a pref, they might divide it into two. So for example, it's a 16% interest rate. Let's say you agreed with them, you're going to give them 16%. They might decide to take one monthly and take the other as deferred pref. So that means you'll be paying them, if it's 16, let's say 8%, you'll be paying 8% of the money they give to you monthly, as like the way you pay your bank monthly. Then the other 8%, you might defer it to when you want to sell or annually. So it just depends on the contract or your agreement. So these things are negotiable. You also need to negotiate the terms. how it will work for you and all that. So sometimes they structure it differently on deals. They might not accept the entire 16% as deferred equity. They might want some monthly and the other deferred.
Awesome. I know we are past our time, and so but does anyone have like a very quick question? You could raise your hand or unmute. Quick ones though. Wait, Kristen, are you speaking? I can't tell. Are you trying to ask a question?
Sorry, no question.
Oh, okay. All right.
I was repeating the info back to me.
Ah, got it.
Yeah.
It's
I'm actually texting and saying thank you for all the info.
awesome, amazing. Alrighty, well, any other questions? Yes, for clarification, when she says, or whenever we say next week, it means in 2 weeks. Just for anyone that's here, because yeah, we alternate with the celebrity Zoom, the activation Zoom. Alrighty. I don't see any other questions. I don't see any hands raised. I take it that you guys may not have one now. Maybe you think about it. I did put the WhatsApp link in there. You can always tag Bibi and ask her a question if something comes back to you. The replay will be available. It's usually uploaded the next morning or day, etc., on YouTube, on our channel. All right. Well, that was great. Thank you so much. And if no one has any other thing, I bid you farewell. Have a great night, guys.
Thank you.
Thank you. Thank you.